Okay, welcome to Nadex, everyone. My name is Chip Frame. I'm with Nadex, and we have Bob Iaccino and Mike Arnold with us again from Path Trading Partners. Today's webinar is going to be the conclusion, part 2, on the Nadex spreads, basically understanding pricing theory and the Greeks. I'm going to let Bob and Mike take care of their own introductions, but we're very fortunate to have these guys again, and they come with a lot of years of experience. In case you missed the previous spreads, I want to let...
Hear me okay?
I can hear you, but I'm still making your introduction. But
I'll wait till you're done then.
Yeah, just a few more words there, Bob, but thank you. Anyway, in case you missed these spreads earlier that Bob and Mike presented, they are now all archived on the homepage of the Nadex, nadex.com under Education. Click Trading Webinars, and it's under the archive. So you have them all, and then this one will be available very shortly after a quick check, but it will be there as well, so you can review these over and over. So we are lucky to have Bob and Mike, and they have agreed to do the Tuesday webinar slots. So we're going to see a lot more of them. But after today's webinar, we are going to take a little break, and they'll start it up again in January. So enough from me. Bob, go right ahead now.
I can talk now?
Oh, you can talk. Thank you very much.
I appreciate it, guys. Thanks, everybody, for being here again. As always, first and foremost, I want to thank Chip and Nadex for allowing us to speak to you guys. We consider it an honor and a privilege that you guys trust us to show you these things, because there is, whether deliberate or without malice, there's some misinformation out there. So we want to get through this stuff, and we want to take questions, and we want to be around, which is why when Nadex offered us future webinars, we gladly accepted. We should be with you guys at least once a week next year, and we hope to give you guys more of these webinars. So I'm going to go ahead and get to the next slide, which as always is a risk statement. And as you guys are probably used to now, if you've been to our other 4 webinars, this is Class 4 Part 2. So it's our 5th webinar, but it's Class 4 Part 2. It was going to be way too long last time. We do actually focus on the risk statement. And we do that for a very specific reason, because trading is not the flip of a coin, whether binaries or anything else. Trading is something that you should learn, you should study. We believe it's a profession. We believe it is a trade, just like being a doctor. It is a trade, and you should all start as apprentices and move on from there. But in the meantime, this presentation is for information purposes only and does not constitute investment advice, nor an offer, solicitation, or recommendation to acquire or dispose of any investment or to engage in any transaction. This presentation is not intended for solicitation purposes, but only for use as general information. This is where we get to the important stuff. All descriptions, examples, and calculations contained in this publication are for illustrative purposes only. If you find a mistake, let us know. We'll fix it. But don't trade off of the data in this particular PowerPoint or any others. The risk of loss in trading could be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition. Past performance is not indicative of future results. Off of the back of that, I'd like to say that everybody listening to me has the ability to be a successful trader on some level. Our job is to take you down the right path. Your job is to find that level. And that's really what that last part means. Okay, you can't have $500 in your checking account, a $1,000 rent check due, and put $500 down on a trade. That's what that means. Don't do that. And if you do that, please don't go out to the internet and say that trading is a scam or trading is risky. You have to accept and understand your own financial conditions, and you have to move forward with that knowledge, because we don't have the knowledge of what every single one of your personal financial conditions are. So we're not going to pretend to advise you without that kind of information. Path Trading Partners is a trading and education firm. Our mission was to form a trading firm that educates, supports, and backs traders who are committed to probabilities, discipline, and long-term trading success, and this is achieved by following the correct path, hence our very clever name, Path Trading Partners. We are not high-frequency traders. We are not day traders. We are a firm that believes in long-term success in trading, covering time frames dictated to us by products, market, and price action. We do not go out and try to find trades. It's a very important point. We don't wake up in the morning, pull up our charts, pull up our Nadex screen and say, I need to find a trade because I need to make money today. That's not how Mike and I do it. We do our analysis and trades either appear from our analysis or they don't. If they don't, I usually go have 26 espressos over the course of 24 hours. I don't know what Mike does. I try not to keep in touch with him if we're not working.
You have 26 espressos no matter what happens.
That's pretty much accurate. Mike Arnold has a lot on his resume. So as always, I don't particularly care to talk about us. I think the two most important things on here, or the three rather, is that he's been doing this for about 23 plus years, and he currently consults to multiple hedge funds, and also that he's a former options market maker, and Nadex products are options. Okay, that cannot be lost, by the way. They're options. Yes, they are yes or no predictions and binaries. We have floors and ceilings and spreads, but if you haven't listened to the other 3 to 4 webinars, there were 3 webinars and there was a 4.1 and this is 4.2. If you haven't listened to those, you'll get a clear explanation in those 3 webinars along with this one as to how spreads are options. Myself, don't care. I'm going to put this up real quick. I'm going to pause for a count of 5, 4, and hit pause and read it. I've been around about the same amount of time as Mike. So in the prior class, we covered an overview of the Greeks, 2 of them specifically, the concept of delta and gamma, and we investigated how delta and gamma react to time and volatility. We saw how, for delta and gamma, volatility and time have the same effect on the spreads. In this session, we will now finish covering the concept of theta and Vega and how time and volatility affect the pricing of a Nadex spread. We know that this is advanced information and it will take some time to absorb it, which is why we are taking our time teaching it. One of the things that Mike and I are repulsed is probably the right word by is when something is just thrown at you guys and people will say, okay, here you go, now just trade this, learn it, you're on your own. As I mentioned earlier, look at trading as being something that significantly augments your income or potentially even replaces your full-time income. You have to treat it like a profession, you have to treat it like a trade. And anyone and learning the exits doesn't know what trading is, and that's what we're here for. So it takes time to absorb a decent amount of this content. That's why it's up on the Nadex YouTube page. Go to YouTube, go to Nadex's YouTube page. You'll see the first 4. You'll see session 1, 2, 3, and 4.1. This is 4.2. You'll be able to watch them as many times as you want. Study these things, and we'll be there over at Path Trading Partners to kind of hold your hand through it if you so choose. So Nadex spread Greeks. Here's a quick review of the Greeks. The definition of each Greek is as follows. Delta is the sensitivity of the spread price to price changes of the underlying. You can kind of look at delta as the price of your auto insurance changing with the amount of accidents you have, right? There's a ratio there, and that's what delta is. Gamma, the sensitivity of the delta to the price changes of the underlying. So gamma measures how quickly delta will move, how quickly the delta will change based on price changes of the underlying. Remember, the underlying is the indicative index on all of your Nadex screens. Now, theta, which is one of the 2 we're going to cover today. Theta is the sensitivity of the spread price to the passage of time. This is extremely important. There's people that tell you that there's no gamma and that theta doesn't really matter because they're one-day trades. Not true. Vega. Vega is the sensitivity of the spread price to changes in the implied volatility of the underlying. We talked a lot about what volatility was last time. You can look at it as price expansion if you want to look at a very simple way of seeing what volatility is. But again, we covered that in the previous three. So theta and Vega is what we're going to be covering. Rho is the sensitivity of the spread price change to the interest rate. We will not be looking at Rho since we are trading spreads on a short-term basis, and Rho will not affect the price of the spread the majority of the time. Most days, interest rates don't change or do not change enough to matter to a Nadex spread, to matter to the price of a Nadex spread. So again, know what delta and gamma is. We're going to go over what theta and Vega is. This is a lot of information. This is advanced information, but it's not so advanced that you can't learn it. Because really, you trade options in your daily life all the time. Again, the example of car insurance, right? You're buying the option that you'll get into an accident, and you get paid off by the insurance company paying the damage you caused. It's essentially an option. So you trade options every day. You know what options are, and you understand these things in day-to-day life. So let us tell you what theta and Vega are, but first I want to review spread price versus the underlying. This is one of the graphs that we looked at, and we have a student who's a member of our Pro Trader program who mentioned to me that he's been studying this and it's starting to sink in. He's been studying the graphs and it is starting to sink in. That is really, really important because the graphs kind of show you visually how things work. So for example, this is a graph of a 100, 105 Nadex spread. Doesn't really matter what the underlying is. Could be crude oil, could be, it doesn't really matter. What you're seeing here is what the price looks like, or rather what the movement looks like at expiration. Okay, so if at expiration we're at 105, it's worth 5. You can see that right there going straight across to 5 here, right? If it's moving this way, or rather if it's at 100, it's worth 0. That's if you're long it, right? So that's what you're seeing there. This particular line here, this green curvy line, is what the price looks like given a certain volatility with 30 minutes left before expiration. Where will the price be? So what does that mean? Well, the volatility difference is sort of illustrated here, okay? Cutting across there. If there's 30 minutes left to expiration and the underlying is at 100, right? In theory, it's going to be worth virtually nothing. But because there's 30 minutes left, it is worth just under 1, somewhere around 90 cents at this particular volatility. Okay? And then up at the top, you'll see the green line is closer to around 4.5 or so, 4.30, somewhere in that range. Okay? Given 30 minutes left, if it's up near 5 or really at 105, it won't be worth 5. Right? It won't be worth 5. And that's an illustration of gamma right in front of your face. And that can change given volatility. The curve of that particular 30-minute line can change based on delta.
Bob, you excellent. I think you said gamma. It was of theta.
Right, I'm sorry, based on theta. 30 minutes. Theta is time decay, right? The sensitivity of spread price to the passage of time. That's why we have that up there with 30 minutes. I meant theta, correct. So that green line illustrates where that particular spread would be in terms of the price of the spread, given the underlying being at 100 or 105 or anywhere in between with 30 minutes left. At expiration, the very rigid straight blue line is where it'll be, is what the price of the option will be, or the spread rather. The green line shows you with 30 minutes left where it will be. So there is your illustration of delta.
Yes. So just to recap what we went on also a couple webinars ago, you know, because we went over intrinsic and extrinsic value. Down below the floor price, there, if you're long, there is no intrinsic, it's only extrinsic value. Between the floor price and the ceiling price, there can be both intrinsic and extrinsic value, although right at the null point, which we've talked about, there isn't any extrinsic value. Right at this moment it crosses the, right here, in this case, to be at 102.5. And above the ceiling price, there is, you know, you can see right here, right at the ceiling price, as Bob was saying, if you're still going, it's worth 5. However, the spread with 30 minutes to go might only be worth $4.20 or whatever. So intrinsically, it's actually worth 5. Extrinsically, it's worth negative. And we'll get into this with theta, and when theta, you have time decay, but also when you can capture the time decay, because time's actually working for you and where it's working against you. So let's get into this then. Then two of the easiest and most useful Greeks to understand are the theta and Vega. Theta models how the spread price will react in regards to changes over time. Vega models how the spread price will react in regards to changes of the implied volatility of the underlying. Both theta and Vega directly influence the extrinsic value of a Nadex spread. That's what they influence. They cannot influence the intrinsic value because that comes from just the underlying interaction and where it is in the spread. It's intrinsically either worth something or not. If it's below the floor and you're long, it's intrinsically worth nothing. If you're above the floor, it's intrinsically worth something. The difference between with time left is how that extrinsic value changes over time. So, price versus time. Let's take a look at this. And don't take all these graphs as we talked about in the last section. They're models, okay, right now, and some of them I've exaggerated so you can really see. You know, depending on the length of the spread, if it's a 2-hour spread or a daily spread, these graphs are going to look slightly different. However, the one thing's going to be the same. As it gets closer to expiration, you know, the spread price is going to change. This shows you at 60 minutes to expiration, it's really the price is along this purple line. 30 minutes, you see it drops a bit. So if the price didn't move, let's say you're up at the ceiling price along the spread, up near this 105 level, and underlying virtually didn't change for 30 minutes. Well, the spread would get closer to the value of 5. Down by the floor, if you were long at the floor, and time changed by that 30 minutes, so from 60 to 30, the value of the spread would drop. Let's say the underlying price, you know, virtually stayed around 100. Then as you're going towards 10 minutes, is dropping more. As you get towards 5 minutes, is dropping more. And then the last 5 minutes is really dropping a lot. So you can see how also theta, or the time decay, is not necessarily linear. It does not move. For every chunk of time, it does not decay the same. It changes. And depending on where it is in the spread, it's not going to change the same. And this is where we're going to get into theta. You can see how, you know, closer to the null point, there's going to be very little changes over time. But at the ceiling or floor price, you can have abrupt changes over time. It can really change over time. Way above the ceiling, not much change. Way below the floor, not much change. But there is some change, but it's not as substantial. So the prior slide is a clear example of the concept of theta. Here's the definition of theta again. I just want everybody to be on the same page. Theta is the sensitivity of the spread price to the passage of time. Now, normally in the options world, you quote theta in terms of days, okay? Theta would be, all right, each day that passes, theta decreases this much. And the only time that really most people really view that differently is on expiration day, because then as every hour passes, or as every, you know, the time decay really kicks in. But, you know, people view it in the day terms. But in the Nadex world, in both, you know, binaries and spreads, theta has to be on a minute by minute basis, okay? So that's how these graphs are really modeled, based off time passage in terms of minutes. Even on a daily spread or something, you have those daily Nadex spreads, the time decay is going to be modeled versus the number of minutes until they expire. And time always decreases. Therefore, theta is the only unidirectional Greek. You can't go up in time once you're in a spread. All of a sudden, you can't add magic time back. I guess there is something with, just thinking off the top of my head, I don't know how you'd model this with, if spreads were theoretically open on daylight savings when they change that time, I guess there could be some aspect, but they're not. We don't have to worry about that. So when they're open, time always decreases. Theta can both help and hurt the spread trader depending on where the position is put on. That's key. That's one of the biggest things I want you guys to take away. There are strategies to capture theta and take advantage of time decay during certain market conditions. And other people have talked about the strategies. I want to show you graphically how that works. So here's how theta is mapped out. And this is a line at a specific time. Theta changes minute to minute. So this is a snapshot at a certain, let's just call it 20 minutes expiration. This is what a great graph of theta would be. And you're going to see how the graph, the curve of the graph changes a bit, but it really stays the same over time, and I'll show you that to you in a bit. But down here you have your underlying price. So you can see, and this is a 100-105 spread. So if it's right in the middle, 102.50, your theta is 0, the null point. If you're down near the floor, 100, your theta is -1, meaning every minute that's going to change, this is going to decrease the spread price. If it's negative, it's going to decrease the spread price. If it's positive, it's going to increase the spread price. So up around the 105, up around the ceiling, the theta is positive at this point in time. Now, when you compare these side by side, this is where a lot of you will have the light bulb moment. Down by the floor price, as we see, remember the purple line was 60 minutes, the green line was 30 minutes, I believe the red line was 10, blue line 5, and the dark blue is expiration. And expiration, of course, there is no more theta because it's expired. But you can see how at this floor price, 100, as time passes, the spread price decreases because the theta is negative here. Up at the ceiling price, if the underline's not moving, you have this positive component to theta. It's actually increasing the spread price, and we're along this spread. We're increasing it. If the value of the underline does not change, all that happens is time passes. The spread value, like at 60 minutes, let's just say it's worth 4. At 30 minutes, it's worth 4.1. At 10 minutes ago, it's still worth 4 point maybe 3 or 3.5. At 5 minutes, it's worth maybe 4.5. And then at expiration, it's worth 5. If the underlying did not change, let's just say the market just virtually went zero volatility, nothing's really happening, the spread price is going to change, and it's going to be positive because of theta, and it's going to be at the ceiling, it's going to be negative, and you can see the farther down towards the floor you get, theta approaches 0. The way above the ceiling, again, theta approaches 0 because the time effect is not much. When it's deep in the money, there's not much, there's very little theta effect. There's some you can see as a separation of the lines way above here at 109 and 110, but there's not much. That's because the theta line's down here close to 0. Again, down here at 95, there's some, but there's not much because we're way out of the money and theta is negative, but approaching 0 from the negative side.
It's a really simple way to look at theta, guys, is to think about as time comes to a close or as we get closer to expiration, how much time is it realistic within the amount of time that's left that this is all of a sudden going to have a dramatic move in the opposite direction or in the direction of either the floor or the ceiling? And that's what you're seeing. The right-hand graph is very important to understand because you can see that if you're long it, right, theta starts working in your direction. If you're up at the top of the spread and you're long it, theta is working for you. And if you're long it and we're down at the bottom, it's working against you, and vice versa. So It's just you think about how much time the spread can either go, or rather the underlying can either go in your favor or against you, and as that time shrinks, that's the time decay we're talking about.
Yes, and that's a great point. That's a great way to put it, Bob, because if you're down at the floor and you want this thing to be worth something, every minute that passes and it's not moving farther in the money, it's hurting you. But if it's up at the ceiling, hey, you want that time to pass, because every minute that goes by, it's helping you. So in the prior slide, we saw how theta can help the trader who is long the spread near the ceiling price. Theta, however, hurts the trader who is holding the spread near the floor price. The opposite is true if the trader has on the short spread position. Just think of that, because if you're short the spread and you're near the floor, every minute that helps, it's going to be worth more than more. But if you're near the ceiling, you actually want it to be going in the money, which is closer to the floor. So every minute that it doesn't do that, it actually hurts you. Now, theta versus time. Yes, time decay happens at any given time, but the theta curve actually changes as every minute passes. So remember, we looked at that curve before, but I always said that was a snapshot in time. Well, as time decreases, theta actually, helps. You saw this, how it became more and more abrupt. The changes over time became more abrupt. Let me just go back a couple slides. So, as you moved a little between 60 and 30 minutes, and then 30 and 10 minutes. But you see how it really amplifies. Like 5 minutes ago, it really can gain a lot here or lose a lot here. Well, that's how you can see it here. 60 minutes. If it's at 105, theta is actually every minute that passes, it's going to add, let's just say a little greater than 0.5, maybe 0.6. With 30 minutes to go, it's going to maybe add, with every minute that passes, it's going to add, let's call it 0.75. With 10 minutes to go, it might add 0.1 to the value of the spread. Well, with 5 minutes to go, every minute passes is going to add 0.15. The opposite of true if this is sitting at the floor. As time gets closer and closer to expiration, theta gets amplified and starts hurting you more and more and more. That's why these graphs look the way they do. So they start spiking. And this is for if you're long the spread. So the closer it gets to expiration, as Bob said before, the more that time's hurting you, because every minute that passes, there's less likelihood that it's going to end up in the money for you and it be worth anything. However, up at the ceiling, the more that theta helps you closer to expiration, so it's amplified. It keeps getting greater and greater and greater, and working more and more in your favor the closer it gets to expiration. So key takeaways of theta versus time. Theta is lowest at the floor price and highest at the ceiling price for a long spread. The opposite is true for a short spread. At the midpoint, theta is 0, what we call the null point. Why? Because there's no extrinsic value. There is no extrinsic value right here or right here in the spread, the null point, okay? Because it's only intrinsic. It's got to flip. The nature of a spread and the way it's assembled via options, it has to cross this point on every spread. There's no way around it. So there's no extrinsic value at their point, so therefore there cannot be any time decay. So theta is amplified closer to expiration. That's one of the key takeaways I want you to realize. For long spreads, theta near the floor becomes more negative as expiration approaches and more positive near the ceiling as expiration approaches. The opposite is true for short spreads. So if you wanted to encapsulate the Cliff Note version, just remember, midpoint theta is 0. Theta is amplified closer to expiration. It gets amplified. For the long, if you're long the spread, that hurts you near the floor, but helps you near the ceiling. And the opposite is true if you're short. So as with the other Greeks we have examined, the absolute value is not necessary to know. It is more important to understand where theta is the highest and lowest, positive and negative.
Ebenezer, I'm sorry, Mike, just because this is a real good point that you said that right now. Ebenezer just asked, my question is, if I need the Greeks to make a decision before making a spread trade, do I have to subscribe to another platform in order to gain access to the Greeks. And Mike just sort of answered what we're trying to do in these webinars. So if you could go into that a little bit again, Mike, and then Ebenezer, I'll touch on this a little bit at the end as well.
Sure. I think a lot of times people get too hung up that they need that information, and you don't need that information. It's better to understand what the graph looks like. Understand what the concepts are here. Because, I mean, let's say you knew, all right, I'm trading this spread near the ceiling price, and there's 5 minutes expiration. Is it really going to make a difference in your trading if you knew the theta was 0.15 or 0.13 or 0.2? I mean, it wouldn't make a difference in my trading because I know what my goal is. My goal is, let's say I put on a spread near the ceiling price, and I'm trying to capture the time decay because I believe the market's going stagnant and not going to move. What I need to know from that is, hey, if I'm going to capture the maximum time decay, I want the market to be trading around the ceiling price and not moving much, because that's why this works to my advantage. The absolute value, again, doesn't matter. If it's 0.15 or 0.14 or 0.18, and this is all going to change with volatility too. You know, it's really the concept of how it looks. And again, if I'm trading something near the floor, I want that volatility. I want that thing to be moving. Why? Because as longer as it sits near that, it's going to hurt me. However, if I put on a spread near the midpoint, and it's sitting near the midpoint, that theta is not going to help or hurt me. Now, if I'm putting it on the midpoint, I'm expecting it to go towards the ceiling because of my model. So then I want it to go towards that ceiling, and maybe I'm putting this on because I'm putting it on at the midpoint, and I know up here at the ceiling, you know, there's significant resistance. For the traders to know support and resistance, there's significant resistance, so this could stall out. Well, that's what I'm sort of trying to model. I'd better to use this information to pick the correct spreads rather than worry about the exact values. Take the concepts of what we're teaching. Go ahead, Bob.
Yeah, so Ebenezer wrote thanks, but that's exactly what we're trying to get across to you guys is knowing whether theta is 0.03 or 0.08 is not the important part. We talk a lot in some of our other education about how traders spend way too much time saying why and not seeing what, right? The correct question is what is happening, not why is it happening. In the case of something like theta, it actually doesn't really go against that, but you'll understand why something may not be moving as quickly as a different option, and down the road you'll choose the different option. That's what we want you to be aware of. So Stella says all we have to know then for now is when they are the highest or when they are the lowest. For the most part, yes, we want you to be aware of when theta is working. Same thing with the other Greeks.
Right, and we'll go into this more in future webinars where we'll take a look at, you know, how the Greeks, let's say we're putting on a trade at the ceiling in order to capture this. Well, what conditions work for you, what conditions work against you, why you'd want to do this, why we're teaching all these graphs and we're showing you and actually showing you physically in a visual way what some of you may have already intuitively known this. I'm laying it out in something you can actually see because that's going to imprint in your brain. And then when we really can dissect maybe what conditions are appropriate for putting on a spread at the null point, what conditions are appropriate for putting on the spread near the ceiling or the floor if you're long, or vice versa if you're short. Once you understand how theta is going to affect it, how volatility is going to affect it, and then like in the prior one, how delta changes with time to expiration and how that spread moves differently as it approaches expiration. Those are all going to be concepts you're going to learn and review over time, and then you're going to go one day, you're going to be going, oh, I know, so I think the market's based off whatever you're watching, or all right, we're going into a slow period in the market, volatility is decreasing, you know, we're caught between support and resistance and the market's gone stagnant. I know based off this kind of spread and this kind of theta conditions, if I put it on here, I can capture that theta. Or the market's breaking out and going into a real volatile time, or we're getting really above a key resistance level, and this spread I think is going to move, so I know if I put it on near the floor based off these volatility conditions, or I put it on near the null point based off these volatility conditions, how I can use advantage. And that's the point that we're building. We're building a core foundation for you guys so you can start putting these pieces together and really become a well-informed spread trader instead of just not knowing exactly what's going on.
So Raphael just threw something in, Mike, and then we'll try to get to the next slide. But Raphael, your question, and I'll read it in a second, is very much what we're trying to get people to move away from. Okay, Raphael says, so if I see that my spread is between 10 or 5 minutes left and there is too much price movement, is it better to close the spread? Sometimes. Okay, so, and I know that sounds like a stupid answer, but things are not so black and white, even in products as structured and easy to understand as Nadex binaries and Nadex spreads. Things are not always black and white. There's such a combination of things that you need to learn, and one of the things that Mike likes to say all the time is a lot of time the biggest problem of new traders is they don't know what they don't know. I wouldn't give you a blanket answer to that question, and I'll let Mike answer as well. There are a lot of times where when there's between 10 and 5 minutes left, yes, it's better to close the spread. But if you're in a 100, 105 spread, and the underlying is at 109, and there's a lot of price movement, no. I mean, why close it?
And that's a good point, because let's say
ceiling. Go ahead, Mike.
Let's say you're up now. If you're right at the ceiling, there's lots of price movement. Yeah, it might be appropriate, especially if volatility is going up. And when we get, I'm going to retouch on that as we look at volatility and how that affects the spread price, because this is where you need the whole picture. But let's say we're way up here. Yeah, even let's say you're way up here and you get more price movement up here. Fine. Unless that price movement is going to take you all the way down here, it's a different story. But if you're right at the ceiling price and you start getting more volatility, more price movement, it might well be appropriate to say, look, I might not have captured all the theta I can, but there's more risk of losing the extrinsic value of the spread than there is that I'll gain by taking the theta out of the extrinsic value. So that's why we're going to touch on the theta and the Vega, and you're going to be able to start assembling these concepts together and then make that decision, because we can't give you a blanket statement. We can give you the information so you're a well-informed trader, so you can go, you know what I learned from Bob and Mike, this is the appropriate time to close that spread, versus, now with the information I know, this is appropriate time to hang on to that spread.
So Raphael, again, that's not a criticism what I said. That's very, very, very common for people to just want a one-word answer to cover every situation. And that's why we've taken 4.2 webinars, 4.5 webinars, to just go into the concept of the structure of the spreads and the Greeks, so that we can give you a big swath of information. You can study it, and it'll start to sink in and start to sink in. That's why we have a really high, relatively high success rate with our traders, because we could give you a blanket statement and move on, and I can go get a pizza and a couple more espressos, but we're not going to do that. That's a very common way to want to look at it, and it's just not that simple. But you're on the exchange where things are simple enough where we can get these things across to you.
Okay, so just to review again, because we looked at the graphs, the last 2 points we didn't get to yet, if there's a theta of negative 0.5, then that means the spread will lose that value. It's negative, so it will decrease the price by 0.5 every minute that passes. If it's positive 0.1, the value will increase by 0.01 every minute that passes. And again, don't focus on the absolute values, because those things change all the time. Now, how does volatility affect theta? We're not on Vega yet, but volatility plays into theta. If there's changes for a given period of time, let's say this is 20 minutes to expiration, and all of a sudden volatility changes dramatically, okay? What's going to happen to theta? And I just want you to take this as, all right, know sort of the way the curve changes. Don't worry about the values, know the way the curve changes. So as volatility increases at a snapshot in time, at a moment in time, if you're up for a long spread, if you're up near the ceiling price or slightly above it, as volatility increases, it's actually going to increase theta. So it actually more if you're above the ceiling price, because you see here's the ceiling price if you're above here, because it can actually push it farther in the money. It can also push it back down, but you can see how it starts dropping back when we get below the ceiling price. If you're near the floor and volatility increases, it can actually hurt you more. It can help you once it starts going in. That's why it's. But if it sits, if volatility increases and it sits like just out of the money or at the ceiling price, let's just take it just out of the money at 99, and volatility increases, but the underlying, because volatility can increase without price moving yet. For example, let's say people are like, well, how can volatility increase without price moving? Well, let's say you're going into a major report and price has gone stagnant, but the market makers, because they're expecting major volatility to happen after that report or news items released, that's a scheduled news item, like crude inventory or something else. Or, this could happen going into a Federal Reserve meeting, in any of the financial instruments. If it's sitting there just out of the money and price is not moving, theta the increase in volatility will make every minute that passes hurt you more as long as the underlying is not moving. Now, if the underlying starts moving, the game changes. But I can't model all those pieces for you. So what you need to do is know, just to take away from this, if volatility increases and you're up near the ceiling and you're long, or above the ceiling price and you're long, and price is still not moving rapidly, it actually helps you. If you're down out of the money or near the floor and volatility increases, but the price is still not moving much, it can hurt you more. So volatility amplifies the effect of theta. This is the most extreme just below the floor price and just above the ceiling price. Now let's take a look at how volatility affects a spread. All right, now we're going to look at, we've looked at volatility and how it's affected theta. Now let's look at how it affects the spread price. So the definition of Vega is the sensitivity of the spread price to changes in the implied volatility of the underlying. Remember how we said before that generally volatility and time had the same effect on the spread? There's a slight difference when it comes to Vega. So here's the spread price versus volatility. Again, you have the underlying. Down here, you have your 100, 105 spread price. So at the floor price, if the, again, underline's right here, if volatility starts increasing and the price is not moving yet, just volatility changes. All of a sudden, I'm a market maker, and I think volatility is going to go from 10% to 40%. So I change the price of the spreads by that, because implied volatility is an input into the pricing model. So if I'm a market maker and I think volatility is going up, I sit at my computer, I say, okay, let's say we're trading at 10%, but now volatility, I believe, is going to go up because of that news report or something else. I punch in my model 40%. Well, all of a sudden the spread price is going to go from down here at any given timed expiration to up here. So let's say it was at maybe 0.5. Now it's at 1.5, just because volatility increased, not the price movement. Don't mistake implied volatility necessarily with price movement. Massive price movement will increase implied volatility as a consequence, but implied volatility can go up because massive price movement is expected to happen before the price movement actually happens. Just as after a report, let's say volatility is really pumped up and that report comes out, well, you're going to get price movement, but maybe price movement just moves a little. Well, that's when volatility comes crashing down really quick. Even though the price is moving, maybe it's not moving enough to still justify the volatility that option market maker had built into his pricing model. So the spread can be moving, but volatility starts dropping down. So let's say that report came out and you had the spread on near the ceiling. and all of a sudden volatility, let's say the report came in exactly in line. Everybody is expecting something weird to come out in that report, and the report came in, with no big news. It was a dud. The price just isn't really moving. Everybody's like, oh, that was nothing. Well, if you were holding it up near the ceiling price at 40% volatility and you had bought it up here and the market's not moving, the underlying's just really not moving, and all of a sudden volatility gets sucked out of that pricing model, drops down to 10%, look at what that does to your extrinsic value. You essentially got that money. Now, the opposite is true. You thought there was going to be a big move. You had the spread on near the floor price, and all of a sudden volatility gets sucked out, drops like a rock. Well, that price, without the underlying moving, drops dramatically. All right, and this is without any movement in time. So volatility can help you and hurt you. The prior slide is a clear example of the concept of Vega. Vega can both help and hurt the spread trader depending on where the position is put on. It's the key takeaway, not the value, but what the effect it could have on your spread depending on where you put it on and the volatility conditions in the marketplace. There are strategies to take advantage of both increasing and decreasing volatility. This is important to understand around predetermined news events or reports. Now, volatility can also change. Something sudden comes out, a big unscheduled event, or something happens in the marketplace. We start getting a lot of price movement. Naturally, implied volatility is going to go up in the market maker's pricing model. All right? It's going to be a consequence of the rapid price movement. But there's many times that implied volatility actually changes in that happen without price movement. So here's just a curve of the spread Vega. And let's take a look at this actually in terms of, all right, so right here, we're around the floor price. The Vega is positive. As volatility goes up, it's going to increase the value of the spread as up near the ceiling. Vega can hurt the price of the spread. It can take it farther away from the spread price. As with the other Greeks, we have examined the absolute value is not necessary to know. It is more important to understand where that should say Vega is the highest and lowest positive and negative. Vega is measured versus percentage increases in implied volatility of the spread. It is really based mostly on a 1% increase. So every 1% increase in implied volatility, it increases or decreases. So implied volatility is determined by market makers and is correlated with the historical volatility, but not necessarily the same as the historical volatility. That's because you can expect future volatility to go up, so they're going to increase the implied volatility even before the market has shown the volatility. If a Nadex spread has a Vega of 0.5, then every percent that implied volatility increases will increase the value of the spread by 0.05. If a Nadex spread is a Vega of negative 0.05, then every percent that the implied volatility increases will decrease the value of the spread by 0.05. Let's take a look at these side by side. This is where it starts getting interesting. So see, remember, the purple line was 40, 30, 20, 10. Now, you see how it up at 105, as implied volatility increases, so let's say it was at 10% and nothing else changes, just say, all of a sudden, you're at 30 minutes expiration, all of a sudden, implied volatility goes from 10 to 40%. It's negative, it actually decreases the spread price. You can see that right here. So if all that changes is implied volatility, the spread price actually gets farther away from that ceiling price. It loses extrinsic value. The intrinsic value stays the same, but you actually lose value of that spread. All that's changed, the price didn't change, the only thing that changed was implied volatility. It's negative up near the ceiling, it hurts you. Down near the floor, you own it near the floor, and this is for a long spread. You own it near the floor. Let's say you own it near this 10%, but all of a sudden implied volatility changes to 40%. Well, you see it's really positive up near the floor, and it adds value to the spread. So as implied volatility, every percentage point implied volatility goes up, it increases the value of the spread. And you can see here that the spread increases, again, without the price actually moving. So in the prior slide, we can see how an increase in volatility helps the trader who is long a spread near the floor price. Conversely, an increase in volatility hurts the trader who is long the spread near the ceiling price. The opposite is true if volatility is decreasing. The opposite is also true for a short spread position. So now there could be a double whammy. If you are, think of this, if you are long a spread up near the ceiling price, implied volatility starts going up, and then the actual volatility of the spread, price action starts moving more and more. You get more actual volatility in the price action. Maybe, more trades start to happen, and the price starts to whip around a lot more. And this ties back to that previous question. Look, you still have time. You're still collecting time decay. However, volatility is going up, so it's offsetting your time decay possibly, because the market maker is pricing more and more implied volatility in. So that's actually hurting you up here, and the price action moving around could actually be hurting you because it could take it closer to the null point and decrease the intrinsic value of the spread. But let's say you get volatility, the spread's going, implied volatility is going against you, but the volatility is going in the direction of the ceiling, and it's going from 105 to 106 to 107 rapidly, 108, 109. Well, yeah, the market maker could be raising implied volatility, so it's hurting you a little. The time decay is going to start kicking in to help you, and the price is going in the direction you want, so you're actually going to be capturing that. So that might be the time, even though this Vega's hurt you a little, to keep that spread on. However, if you see implied volatility coming in without the price moving, and all of a sudden you notice the spread moving against you and the price of the underlying isn't changing, and then volatility starts coming in and it's not necessarily going higher, that's when you might say, hey, I know these concepts. Yes, I'm capturing time decay, but that volatility, implied volatility, is moving against me. I might want to exit that spread early. Conversely, down here, that theta was hurting you, maybe with time to go. However, you notice the price, implied volatility, that spread, hey, actually that price is increasing in that spread, the underline's not moving. We're going into that report, and maybe I have a strategy to say I'm against a really strong resistance point. So I'm using that implied volatility to work in my favor to offset that time decay. Maybe I'm going to hold that spread, all right? Now, this is all strategy dependent and everything else, but what I'm trying to show you here is the reason you have to understand the theta and the Vega is because depending on the market conditions, there is no blind yes or no answer. There's actually, as we get into this, and we'll do future webinars on this and investigate all the nuances if you have a spread on near the ceiling price, or if you have a spread on near the floor price, or if you have a spread on near the null price, and how everything sort of fits together. So we'll take sort of a deep dive approach in future webinars at all those things. So stay tuned, because some more other questions will get answered in those. So in the prior slide, we can see how an increase in volatility helps the trader who is long a spread near the floor price. It hurts the trader who is long the spread near the ceiling price. The opposite is true if volatility is decreasing, and the opposite is also true for a short spread position. Now, real quick, just as point of completeness, Vega versus time. And this is what happens if, as time gets close. So implied volatility is now staying the same. All right, we're not changing implied volatility. So let's just say it's at 20% or 30% for this example. The only thing that's changing is time. So as time changes, as you get closer to expiration, the effect that Vega has on the spread up near the ceiling price or above it is less and less. You see it's getting less and less negative. Below the floor or even at the floor, as time decreases, the effect is it gets less and less positive. Okay? So time also changes Vega. And that's not something I want you to worry about as much. That's a really advanced concept. It's in here for the point of completeness. But just know A couple key takeaways. Vega is highest at or just below the floor price and lowest at or just above the ceiling price for a long spread. The opposite is true for a short spread. At the midpoint, Vega is 0. Again, midpoint, Vega is 0. The null point, that's why let's go the null point, because how many of these Greeks are 0 at the null point? Vega decreases as time approaches expiration. For long spreads, Vega near the floor decreases as time approaches 0, and Vega near the ceiling decreases as time approaches 0. They decrease. Vega versus volatility. So you can see again here, Vega versus volatility, you have the null point, you have the ceiling price. This again, advanced concept just in here for the point of completeness. You can see how as volatility goes down, it really starts spiking lower near at the ceiling and at the floor. It really amplifies volatility as the biggest effects at the floor and ceiling. It's really the takeaway right there. So an increase in volatility positively affects Vega most when the price is below the floor price, and increases in volatility negatively affects Vega most when the price is above the ceiling price. This is true for traders who have long spread position. The opposite is true for traders who are holding a short spread position. This is not critical. I'm more focused on how the initial things we talked about with Theta and Vega affect your spread prices.
So let's wrap up the Greeks, and there's a couple more comments on here, but I want to just finish up these next 3 slides, and then we'll get to questions. And Raphael, you are the kind of student that we actually love because you are inquisitive and you are asking the kind of questions that we're used to answering. So I'm going to get to that last comment you made. You may need to review this information multiple times. It's not necessary that you worry about the absolute value of the Greeks, going back to Ebenezer's question, while trading the Nadex spreads, just that you understand how changes in price, time, and volatility can affect your spread position. This is when you need to know, well, let's see, I put on the perfect trade. Why isn't it not working the way that it should? The underlying has moved 5 points. Why has my spread not moved 5 points? It's because the effect that the Greeks have on it. Right? That's all we're trying to get across to you, and you'll learn over time. It won't be as long as you think, but you'll learn over time how these things, or when these things will affect your trades the most and when it will affect your trades the least. As Mike mentioned, all of the Greeks seem to be at their lowest at the null point, right? That's why it's called the null point. So there's going to be a lot of strategies we teach in Path where we talk about the null point and whether or not that's the best place to put on a spread or not. In this webinar, we covered Theta and Vega in a fair amount of detail. We examined how the underlying price, time, and volatility changes affect the spread price. All this will play into how, when, and where a trader puts on a Nadex spread. This will give you an inside track to establishing Nadex spread trading strategies and designed to successfully capture certain market events. That's the goal, to be able to get you guys to understand why the spreads themselves are such a phenomenal product. Okay, the product is really, really good, and the Greeks point to a lot of that. All right? So before I go into questions and answer a couple of the ones that are on here, please follow us on Twitter at path_trading, like us on Facebook, and visit us at pathtradingpartners.com. We are starting our strategy, our pay-for strategy lessons Thursday. So you still have time to join and get in on them while they're being taught live. There's a massive advantage to being involved while it's being taught live, and the advantage is about to start now in this webinar because we're going to go to questions. But again, we're starting our strategy at Path Trading Partners Thursday. You can still sign up and join, and we'll be teaching a high probability reversal strategy that you can then impart your market view in the spreads or in the binaries as well. So I'm going to take some questions now, but first I'm going to go to Raphael's, and Mike, as always, chime in wherever. Raphael said, I saw in the 8 to 4:15 p.m. US 500 spread that in the last 5 minutes, in most of the cases, it moves more than 3 points. This is why I like this comment, Raphael, because one of the things that we teach is to not make sweeping conclusions from limited data. When you say in the last X amount of time, it moves 3 points, we have heard that kind of a comment so much, and that is probably the perfect example of a sweeping conclusion from limited data. When Mike and I look at strategies, we take massive amounts of data before we say that something usually happens. And we'll usually only apply the words high probability to it. I'm pretty sure that whether you're talking about the US 500 itself or the options, binary, or spread that you've been trading, it probably doesn't usually move 3 points in the last 5 minutes. Just happens to be the small period of time that you looked at them that these happen to move. So when you want to make a comment like that and you want to base trades on it, you have to do actual research. And this is not a criticism. This is a teaching lesson. It's a teaching opportunity for Mike and I to say that you never, ever, ever make sweeping conclusions from limited data. You never take a situation where you say, I've seen this happen 7 times in 10 days, and not know that Nadex has been around for years, and options have been around for decades, and the US 500 has been around for multiple decades. So it probably doesn't usually happen. It probably only happened the handful of times you looked. So be very, very careful of wrapping a trade idea or a strategy around that kind of assumption. And like I said, Raphael, you're inquisitive, and that's the best kind of student we can possibly have, because you're asking questions that other people might be afraid to ask or comment on, and you're helping everybody that's listening. So thank you very much for the comments earlier and that kind of a comment, okay, because that allows us to teach other people some of the things we want to make sure they know. Andrew says, other options book. Thank you for describing Vega and Theta. Thanks for your illustration. Great companion for Nadex spreads. Thanks, Andrew. Charles, go ahead, Mike. Yeah, go ahead. Yes, yes.
I just wanted to comment one thing about what you were talking about before. And yes, you could have seen the move 3 points, but that's one component. What I'm trying to get across to you is what did the underlying do? You know, because you could have seen it move. One day the underlying could have moved a lot, you know, so it increased. One day it could have been stagnant, but there's volatility built in that got sucked out with the time on the last few minutes. There's a number of ways that spread price could change. There's moving components to these spreads. That's why we have a delta. That's why we have, you know, gamma, theta, vega. Time's linear and time's always going to affect the price. So that can be something that affects it, especially with very little time to go. It's going to get amplified, as you saw in this presentation. But then you have other moving parts. One of the big ones is what did the underlying do? Because the delta especially also gets amplified close to expiration. So that, you know, how much did the underlying play as a component to that? How much did volatility, if any, did it change going into that expiration? So you had multiple parts that you have to assemble together. That's where just looking at just a price change of the spread without taking into account the other moving parts can be misleading, because you can have the same outcome, but it could have been caused by different components, different times.
So I want to touch on something really quick, back to Ebenezer's question, because I also got an email like this recently. And Michael, yes, this is recorded, as Chip mentioned earlier. Michael Barron says, I got in late. Will this webinar be recorded? As Chip mentioned at the beginning, which you obviously weren't here for, it's going to be up on the Nadex YouTube channel shortly. Iza says, thanks for the great explanation of Theta and Vega. So back to Ebenezer's question about, do I have to switch to another platform? One thing we're going to do, we're going to commit to, and I can say with a high degree of certainty, I can't guarantee, but I'm going to say with a high degree of certainty that nothing we're going to put out for you guys is going to be platform specific. We're going to try and put out products. I know we can do it with our strategies and our courses. We're also going to try and put out products where you can stick with the platforms you're comfortable with, and most of the stuff is going to be stuff you can just use on your regular computer and with Nadex charts. So we don't want you to have to be tied to a specific platform that we happen to like or we happen to push in order to be successful. We're going to make sure that you can do things the way you want to do them within the parameters of doing things correctly. Charles says, what is the risk of a spread losing liquidity as it gets closer to expiration? Look, a general answer, and then I'll pass it over to Mike, is that's really market maker specific, right? In spreads that are popular, you probably have less of a chance. In spreads that haven't had a lot of trading in them, probably more, but you see that in binaries as well.
Right, and it is somewhat, I mean, there's a cutoff time for all spreads where, you know, the market makers take down their quotes before, so you should know what that is per duration of spread you're trading. But it's also, other than that, you know, it is market maker specific, and depth of market makers and how many different market makers are trading any one spread, because they don't all have to change things at a different time. But that's something you're going to also gather by, all right, you know, you're going to trade the US 500. Well, after trading it for a while, you're going to know, and all right, let's say you're trading like the daily US 500 spreads, you're going to know aspects of that. You're also going to know a lot of these things. This is another reason you don't have to understand the exact absolute values of a lot of this. Once you understand these concepts, you're going to start to see these things occurring in the spreads. You're going to start seeing, like, hey, that price of the spread's changing by this amount, but the underlying is really not moving that much. Now you're going to know, well, it was, of course, it couldn't be, you know, is that due to the theta? Is that due to the Vega? Et cetera, et cetera. You're going to start seeing these things by repeatedly trading a product over and over again. You're also going to see some of these things with liquidity and how it affects the spread price and what market conditions affect the spread price. Like, is it in super high volatility markets, what happens to the liquidity? What happens when, or does, you know, do the market makers, you're also going to learn this, do they really pump up the Vega? Do we have, you know, all of a sudden a really big price movement and then Vega goes through the roof and you see the spread price actually get to an outrageous level? Because, I mean, that happened a couple months ago, and that's where you're also going to want to understand, hey, I know how this affects the floor and the ceiling price, so this is really at an outrageous level. I should be looking maybe to try to capture some of that theta based off of certain trading strategies. Oh, that trading strategy triggered, we're at a really high implied volatility. I now know maybe I want to capture this time decay, so I'm going to implement this kind of strategy and put on this long spread near a ceiling price or a short spread near the floor price, because you've witnessed all this stuff unfolding in the marketplace. That's why you don't learn trading overnight, and there's no blanket statement we can give you. We can give you the tools. We can give you a hammer, but you're gonna, and a saw and nails. But just because we give it to you, you're not going to be able to build like a table and chairs overnight. You're going to have to practice with this stuff. But if we sit and give you those tools and teach you the proper ways to swing that hammer, the proper way to hammer that nail, the proper way to cut that wood, over time you're going to get better and better and better at building those tables and chairs. Any more questions, Bob?
Yes. Andrew says, should we try a practice trade for tomorrow's Fed rate announcement? Andrew, I would ask you what trade. So first I'm going to say no. What I'm going to say to you, though, is watch the different spreads. You got to watch this stuff first and start to get a grasp on the different types of price movements and the different types of expirations. You'll have some 2 o'clock expirations that will react differently than the 315s will, and some of the currency ones that are going till 315 and that started the daily. I haven't really given you a strategy. We've given you some of the components that you need to know to construct strategies correctly. Andrew is saying just to see Vega and Theta reactions. You will see some of it, yes. Yes. I just don't want you to try a practice trade. It'd be irresponsible, and I don't think Nadex will get mad at me for saying this, but it would be irresponsible for us to say to you, okay, now hurry up and take this and go trade, and hurry up and fund your account and we're not going to do that. We want to make sure you guys get the foundation you need, and when you have that foundation in place, like Mike said, then you grab the nail and the hammer and the saw, and you start to build your trading house. All right, when all you have is a hammer, everything looks like a nail. All right, that's one of Mike's favorites. I love that one. When all you have is a hammer, everything looks like a nail. So we want to give you the entire toolbox, then give you the nails and the wood, so you can build everything correctly.
You know, and tomorrow will be a good environment to really, with the Fed announcement, to watch, depending on whether we have a lot of price movement or not a lot of price movement, how spreads react. So it's a really good time to watch it tomorrow, because you're going to be able to see stuff. It's maybe good to take some screenshots or something, like right before, and then gauge it, because then you can go back and look at the different, hey, the spread was priced at this. You know, look at the intrinsic value. Try to maybe look at a spread near a floor or a ceiling price, and then you can gauge the intrinsic and extrinsic values and see, hey, price didn't move that much, but the spread changed this much, or price moved a lot. See, you can compare a spread. You can say, let's say, even though it moves a lot, you can say, look, it moved into this next range, or when the next set of spreads open, let me compare the floor price to a new floor price at a new thing, because you're comparing apples to apples. All right, you can somewhat compare the extrinsic value and start to say, okay, even though it moved a lot, when it was at the floor price before the announcement, there was $5 extrinsic value. Now, after the announcement, the market's moved a lot, but let me take a look when a new spread opens to start trading. It's at the floor price. Now it's only worth $3, or now it's worth $8. You know, with the same maybe 2-hour window spread. So you're comparing apples to apples. So all those things can help you start understanding and start putting these pieces together. And that's stuff you can do on your own while you're in front of your monitor every trading day.
And we'll never give out trading recommendations, but we'll cover some of this stuff as well in Path Trading Partners in our courses, because you'll have examples of specific movements and times as the courses develop. So you'll see the things. You'll never have any trading recommendations, but you will see specific examples of, okay, here's an example of when the rig count announcement came out. Here's what happened to crude, and it was affected by X, Y, and Z. We do that in our courses. Really good question from Stella. You've covered all this information regarding spreads. Do all of the Greeks and everything apply to binaries as well? I'm going to go ahead and give that to you, Mike.
Yes, they do. And we'll be doing in January a 2-part Greeks webinar on the binaries and how all the Greeks affect the binaries. So, because a binary is an option, and you can model the option. That's how you price it. You have a pricing model, therefore you can come up with the delta, you can come up with gamma, you can come up with a theta, and you can come up with a vega. And they look different from the spreads. I'm going to tell you that right now. So it's something to stick. It's something to understand. So don't try to apply what you learned from the delta, theta, vega, gamma in spreads. Do not apply that to the binaries. They are different looking curves. They're actually, a binary is a derivative of a vanilla pricing model. You will see some neat things and how they fit together, but the curve for delta in a spread is not the same curve for delta in a binary. The curve for theta in a spread is not the same curve for theta in a binary.
And contrary to popular belief, there are deltas in both and there's gamma in both. I shouldn't say popular belief. Felipe, you're welcome. Felipe has said twice, thank you for this webinar, and we appreciate you guys being here. Andrew says thanks. Are there any other questions, guys? Again, the live classes, which will later be recorded classes for Path Trading Partner, begin Thursday, 4 p.m. Central. You have to go to pathtradingpartners.com to be a part of that, and you have to join Path Trading Partners to get into that. So that's going to start. Again, if you want to become a member later, we'll be here, but you have the opportunity to be in these classes when they're taught live, which obviously, again, the advantage has been shown in this webinar where you can ask questions. And again, those of you that ask questions, we really appreciate it. You are not only helping yourself, but you're helping us teach the other people who might have the same question and just aren't the type of person that asks. So the more questions, the better. But if there's no more, I don't want to keep you guys. We got a Hawks game tonight. We got all kinds of stuff going on. So
I
Again,
just
thanks
wanted
for
to
having
answer
us.
the questions too, Bob. They're really good questions. And, you know, keep coming to all these because questions will hit you at a later date, and there'll be lots of opportunities to ask these same type of questions when we go over different concepts of spreads, different concepts of binaries, you know, because now you have the solid foundation. So absorb this information and then attend the next ones so you can ask those questions too.
Okay, guys, I think we're all set on the questions. This was really, really a great webinar. So that wraps up webinar number 4, part 2 on spreads. You will be able to see this in the archive section. I should be able to get that up in a couple days. If you go to you can see it on our Nadex YouTube channel. You can also see it on our homepage, nadex.com. Click on the education link under trading webinars and click on archive, and you'll see all these spread webinars to review as many times as you want. But it's all good stuff. And as they said, they'll be back in January to do this all over again on binaries. So thank you very much. And I guess that's it. Have a good one. Take care.